Welcome. One of the questions I get asked quite often are what are the pros or cons of investing in real estate limited partnerships? As with any investment, there's always risk regardless of what you do. There's risk related to investing in stocks or bonds, gold, silver, and real estate, there's no exception either. Of course, there's going to be pros and there's going to be cons. I think at the end of the day, the pros outweigh the cons, but after we walk through this, you can decide for yourself what makes more sense. For me, I think the biggest pro of investing in real estate limited partnerships is access to deals. You get access to deals that you might otherwise not see if you were trying to invest on your own. Everybody gets tapped out at some point with how big of a deal they can do. But if you align with the right sponsors, you can do bigger deals, or you can do deals in different geographic markets, or you can do deals in different asset types. And so it is interesting in a real estate limited partnership that you'll have more access to deals, not less, and very oftentimes you'll have access to deals with better sponsors. And so that is number one for me as a pro. I think the second thing that is the most important part of real estate limited partnerships and the pros from that is that you get current cash flow. With most real estate limited partnerships, you generally have distributions that are going to be happening either on a monthly or quarterly basis. That means you're going to get paid every single month or every 3 months, depending on the deal. Current cash flow is huge. So you want to look at the deal, you want to look at how durable that cash flow is, but having that current cash flow is a huge pro of real estate limited partnerships, which you don't always get with stocks unless you have a dividend paying stock. The third thing that you get with real estate limited partnerships is that you have upside potential. Now, in a real estate limited partnership, sponsors are the ones that are overseeing the investment opportunity, but you still get to benefit in the lion's share of the profit potential. And the reason is that while sponsors do the work, they don't take all the upside. Because of the risk capital that's involved, most sponsors pay out a proportionate amount, a larger than proportionate amount, to the investors who provided the risk capital. So, a structure that you'll often see is a 6% preferred return and a 70-30 split between the investors and the sponsors, respectively. So, the investors would invest, let's call it $1 million, and they would expect to get a 6% preferred return on their money each year. So you'd get $60,000 of current cash flow at a minimum, and then for any profit above that $1 million, so if they sold the property and they got $2 million back at the end, then the first $1 million goes back to the investors and any preferred return that's not paid. But let's say that $1 million is pure profit, then the investors would get $700,000 of that, and the sponsors would get a $300,000 sponsor promote. But the investors get the majority of that. And so you have upside potential. You also get upside potential because the sponsors are trying to improve upon the operations. So they'll be increasing rents and bringing those to market in the cases where they're not at market already. Sponsors will be trying to reduce expenses, and sponsors will even be trying to get the best financing possible because financing can be a value add. But doing work to the exteriors, that will be something that the sponsors do. Doing renovations to each of the units to increase the value at the property level, that's all upside potential that the investors have a chance of earning. The fourth thing that you get with real estate limited partnerships is diversification. In an example of a deal where you may have to buy a property for $10 million, if you had to invest all by yourself, or if you decided to invest all by yourself, you may have to put in $3 million to $4 million of equity to close the transaction. The sponsor in a transaction may go out and raise $3 or $4 million, but that's sprinkled by a number of investors who are investing smaller amounts. So you may have a group of investors that on average are putting in $25,000. So if you had the diversification, if you had a couple $100,000 to invest, and the minimum buy-in was $25,000 on each of those deals, you could have an opportunity to diversify into 8 different deals. And then that way you could get different assets, different asset types. You could invest in different geographies with these sponsors, and you could invest with different sponsors. Then you get at least 3 different layers of diversification that I believe is hugely important for real estate limited partnership investors. The 5th thing that you get as a real estate limited partnership is a tax advantage. So in the early years of real estate limited partnerships in particular, you may be earning current cash flow, and that may be sheltered by depreciation, thereby having a reduced tax bill. Now, if you do have to pay taxes, we'll talk about one of the disadvantages of the preferred return for real estate limited partners. But you do have tax advantages where you can pay reduced taxes on your preferred return through shelter. You can also do capital gains where you defer capital gains through a 1031 exchange. Or you can also invest in opportunity zones, which came up with the 2017 tax code changes. And opportunity zones give you the availability and the opportunity to negate your taxes or defer them even longer. Now we're going to discuss some of the cons of investing in real estate limited partnerships. The first con of investing in real estate limited partnerships is the lack of the control. The sponsors make the decisions in real estate limited partnerships. The investors are effectively deciding to back the sponsor, the investment opportunity, but they don't have much say in the operations and the management, the financing, or the sale of the asset. So lack of control is probably the biggest con related to real estate limited partnerships. The second one is illiquidity. In the documents, this is unlike a publicly traded stock. Shares of real estate limited partnerships are illiquid in that they are private, and there's not a ready market of buyers that are available to purchase real estate limited partnership interests. Which brings me also to number 3, which is the saleability of limited partnerships interests is limited. And what that means is that it's very difficult to sell a limited partnership interest, and a lot of times the documents in real estate limited partnerships through the PPM or the offering memorandum don't give you the opportunity to sell your limited interest even if you want to. The next area that is a con related to real estate limited partnerships are tax rates related to preferred returns. Tax rates on preferred returns and dividends are taxed at ordinary income levels. As such, those tax rates can be very high. But like I said, the offset for that is that there often is depreciation or shelter that you get on your income. And you can have a situation where you are earning current cash flow that is very good, and your tax rates are negligible or zero. And thereby that could actually help you in your tax situation. The 5th area that is a con related to real estate limited partnerships is the fact that some investors feel that the investments are slow growth. Generally what you see is that you're going to get a 5 to 8% cash on cash return on your investment dollars. Over time, you're probably going to get somewhere between a 12 and a 15% IRR, maybe even higher, and that would turn into a 1.75 to 2x equity multiple, maybe over a 5-year period. But investors often look at the current cash on cash return and think the 5 to 8% is very slow growth. So if you invest $100,000 and you get back $5,000 to $8,000 per year, that seems like it takes a long time to get your money back. But if you're in a business plan where you're going to be holding for 4 to 7 years, and year 5 you decide to sell, you get all of your preferred returns for those 5 years, you get your cash back, and then you make profit. The profit at the end can be a very nice pop, and it can increase your IRRs overall so that you're in that 15% IRR range. The final area that is a risk and a con with real estate limited partnerships is that there is no guarantee of a return of your capital. There's no guarantee of a return on your capital either. So effectively, even though you have a preferred return, the preferred return means you as an investor are going to get paid before the sponsor benefits from any of the upside. So as long as your preferred return is current, the sponsor can also benefit in the upside. As I said previously, if you have a 5% preferred return and then the sponsor pays out 10% for that quarter or for that year, and you had $1 million investment and the preferred return is 5%, you're at $50,000. If the investor or the sponsor paid out $100,000, then the sponsor would share in that additional $50,000 on a 70-30 basis or whatever the number was. So the investors would get on that $50,000, they would get $35,000, and the sponsor would get $15,000 of sponsor promote. So those are the areas that you need to think about related to the pros and cons of real estate limited partnerships. Every investment carries risk. You need to make sure that you're comfortable with the risks of each deal. Do your analysis, always do some due diligence, and make sure that you take action on the deals that you like, because for me, the pros outweigh the cons. And until next time, look forward to continue growing our cash flow and net worth together. Feel free to reach out with any comments or questions. Feel free to share the link as well and let people know what we're looking to do. And if you have any investments, dollars that you are interested in putting to work, feel free to reach out to us. We'd be happy to work with you and see if there's an opportunity for you to co-invest with us. Likewise, if you have any real estate financing needs, Guardrail Finance is a real estate investment banker, and we can provide and arrange loans for you with various capital sources across the capital stack. Thanks so much for your time. We look forward to seeing you on the next one.